Okay, so basically all I want to do in this conversation is bring up some of the big questions I'm most confused about and randomly talk about them. So let's start with let's start with one that I mentioned yesterday. I just find this the most confusing. So today, we have equity markets and commodity markets where we have booms and busts based on speculative demand, right? So it's like you have a lot of momentum trading that happens. People buy because it's a bull market, just like crypto. We're all into the crypto context, but this happens in the stock market as well. So relative to the dollar, you have the whole market going up a lot and going down a lot. But there's an interesting question of what if all of those, let's say that we had an R token. We don't even have to think of it as an asset-backed currency for this intellectual question yet. Imagine you just had an R token that's like a total stock market index. And then each individual stock traded against not the US dollar, but against that total stock market index token. And that was just how the stock market worked. Could you have general market crashes? Like, what would even happen, right? Because how can the value of all of the stocks go down relative to an index of all of the stocks itself?
Well, could you use that thing to buy other things that aren't equities?
Sure.
So like eggs.
Yeah.
So that you would know it goes down in terms of eggs, not in terms of itself.
Well, yeah. So you could see, maybe it would go up and down in terms of eggs. But let's say for the hypothetical that it's just an index of all the equities, not also eggs. So yeah, it could go up and down in terms of eggs. But still, like, what would the market itself look like? What would the market for equities? What would the price trajectory look like? Would you somehow be able to magically eliminate like overall market trends of booms and busts, or not?
Is it similar to Forex markets?
Well, it's different from Forex markets because of the fact that everything's traded against this index.
Do you have some kind of standard deviation like thing that you might start watching? Is the standard deviation of this market?
So so the thing is let's just say for simplicity, there's only 10 stocks. Okay? So you have all these 10 stocks, stock 1, 2, 3, 4, etc. And then they're all traded against this index of all 10 stocks. So obviously you could have the price of each stock individually go up or down relative to the base asset, the index asset.
How does the index rebalance?
That's a good question. Let's just say, I don't know if this is going to work out, but let's just say that the index is just a fixed number of units of each stock. So each company has, 1,000 shares, and each unit of index is just like one share of each company. So it doesn't rebalance, I guess. You can take the assets and mint the sort of index coin, or you can redeem the index coin and get the underlying assets. So that the amount of the index asset can go up and down because you can mint and redeem it like an R token. Mm-hmm. But there's no rebalancing of the basket in the index. It's always the same.
You can never get away from past prices. So when you create this thing, there will always be what was it worth in dollars before, or what was it worth in gold, or anything like that. Even all the way back.
Okay, so we would have that history, but then we would have a history starting when this new regime came into being, where it's like, okay, now we have all these market prices of each stock versus the index. So again, you would see, okay, wow, stock 1 is mooning because it's an AI company or whatever, and it's like,
No, it's 90% of the index.
Yeah, and in terms of value, it's going up a lot, right? And stock 5 is like not doing very well compared to the index. But my question is, would you actually eliminate the overall stock market booms and busts because they're traded against the assets themselves, and so you just sort of, if the value, if everyone's buying into the market, well, they're buying into the market with the assets in the market itself. So you see what I'm getting at here?
You trade S&P in terms of S&P, then there's no booms and busts.
Right.
But you still.
So is this a
if you can
brilliant
spend
way?
the S&P to buy a cup of coffee,
So,
that's all good.
right, but so is this a brilliant way to eliminate market like booms and busts and speculative volatility, or is there something fundamentally wrong about that idea? That's my question.
Don't we already kind of have this with like most flows are passive into the index? And a lot of like institutional volume for like the people who are actually like trying to do long short equity, it's like shorting the S&P and buying Nvidia and Microsoft. And like even in this current regime, like we did have March of 2020 when there's a like cataclysmic world event. And people were trying to get liquidity, the world was ending, like you still have wars.
But so I mean, one way of thinking about it is like, in a way, if a given investor either chooses to hold some specific set of equities or the 500 index, and they're just going back and forth between those two, and they just don't care about dollar terms, then in that sense, maybe they kind of are already in this world where it's like the market doesn't look that volatile to them. Only individual things look volatile to them because that's their reference. But then I'm asking like, in this weird, I mean, maybe it's gonna be impossible to achieve, but like, if the market never traded against anything other than the index, would everyone just like feel chill and not try to speculate on booms and busts because there were no booms and busts? Or would there somehow still be booms and busts just of a different type? I mean, like, you could have them against eggs.
How do you get in and out of the market in your thought experiment?
Well, your money in the way I think of this, like if this was an R token and it was, used to buy eggs, then your checking account just is the index of all the assets. And then if you want to get into the market, that just means you're choosing, instead of holding the whole index, you're choosing to buy some particular assets, some combination of particular assets.
So you're describing a closed system.
Yeah.
The economy is not a closed system. So how do we get in and out of the market?
Well, what do you mean by get in and out?
He's saying you have to start with the index as your thing. You're buying the stock.
If
Wait, what?
the index is your currency,
Yeah.
yeah, I mean, it's a question of how we would transition from this world to that one, but let's say that had happened, right? So we were all holding the index.
You're not understanding like how the GDP turns into a bigger economy in this scenario. Like what is, how does this market grow?
Yeah, you mean like, well, what do you mean by that?
Well, so it seems like there's an assumption in the thought experiment that people are never gonna hold cash. That like,
Right.
we're settling everything. And so I think that answers the question you have, which is like, okay, well, we're only thinking about the index.
This market's kind of a black hole and there's nothing outside of it, the way you proposed it, which means there's no reason to be in this market does nothing for you. Like, what is?
Well, so another weird thing about this is, let's expand the hypothetical further.
Yeah.
So again, just how I think about it in the tower. So, like, the companies in the market would also earn their revenues, their income, in units of the index, because that's what people in the economy would hold and pay with. So that's weird. It's like the companies are like acquiring greater and greater ownership of each other. They're all just sort of in competition for ownership of each other because the whole currency in this weird system is just an index of the equities. So like their cash flows in the future would be denominated in units of themselves. It's like, again, I'm bringing this up because it's like, is this a terrible idea or a genius idea? It's like, it's hard to tell.
I still think we need to talk about how this system grows as a whole, how this pie gets bigger,
Okay,
or how this pie gets smaller.
yeah.
And you're not doing that, you're just basically saying,
Okay,
we're moving
okay.
around pieces
All
of
right,
the pie.
all right. Let me propose an answer to that. It's a good question. So, my off-the-cuff answer is, well, okay. Instead of just 10 companies, let's make it a little more realistic. They're gonna be new companies,
Okay.
right? And when new companies are created, every company still has to have 1,000 shares, and they're just auto-added to this index. And so now the index, instead of 10 companies, it's 11 companies, 1 share of each. And so the whole pie can grow because new companies can come into existence and produce new value.
Did the pie grow or did you just cut it into smaller slices?
Well, I mean, if the if there are new companies producing new value, then in some sense, I feel like the pie grew. It's hard to think about how it actually works, but
How did it get decided, how does that company, what does that company get when it comes into existence, and how did that get figured out?
well, I guess, okay, it's a good question. Let's say that when the company comes into existence, I mean, it has to raise some startup capital. So it does that by selling its shares to, people who hold the index in exchange for slices of the index. So now it has acquired a little bit of ownership of all the other companies because that's the currency in this hypothetical economy.
This actually means that there can be no more, and I think some of our assumptions make.
Smaller slices.
There can be no more than $1,000 bills. Because there's only 1,000 shares of each company.
That's true, yeah.
So there's a limit on the amount of money.
Yeah.
No, but companies can issue new shares, right? I mean,
Well, in my hypothetical so far, they weren't allowed to issue new shares. You can issue as many new shares. Let's say you can issue as many new shares as you want, because that's what companies can do. And let's see what happens with that. So, okay, so companies grow, they issue new shares at times.
Yeah, lots of little feds.
So, okay, so then basically the number of units of the index is just governed by the number of shares that the companies choose to issue. That does seem a little scary, because then the companies can just,
Well, like to issue new shares, someone has to be willing to buy them.
that's true, somebody has to buy them, yeah. So
They buy
maybe
them
that's
with,
fine.
with the asset.
Yeah.
You bind them with the
And
other
then
companies.
the companies have their own shareholders
Yeah.
who don't want to dilute themselves. So there is like a clear incentive to not just like, you know,
You don't have nobody needs to buy them. You issue them, there's more units to supply currency.
well, but when you,
Scrooge McDuck example.
but if you issue them, how do you, let's see. Scrooge McDuck.
No, like a Delaware C corp, right? Like you would have a bunch of outstanding, like shares issued that are not assigned to anyone. So they're not actually used in the valuation.
Right, like, let's think about from issuance, what has to happen for them to then be used to mint more units of the currency? They have to, someone has to, I mean, I guess if you issue them and you as the company sort of control them, you then still have to go buy up all of the other shares of all the other companies to combine with yours to mint new units. of the
I
currency.
think taking this example from 1,000 to bigger is actually less helpful than let's take it from, let's say there's 2 companies.
Okay,
And now we want to add a third.
okay.
That
So-
might be
all right.
easier to understand,
All right, so
like
there's
what happens.
2 companies with as many shares as they want, or with 1,000 shares?
Well, fixed.
Okay, let's go from one company to 2. Let's start, I've got one company that's got as many shares as it wants.
Okay.
And now another company wants to join.
Okay, so there's one company with as many shares as it wants. So that's a weird world because then they can just mint infinite units of the currency because the currency is just a wrapped version of their own share.
But they're the only one. doing it.
Okay, and then, all right, let's see where this goes. Then another company comes into existence. And so the index auto updates to be, has to be 1 unit of each, 1 share of each company. So it's a kind of weird rebalancing thing that happens where then half the shares that are currently in it are sold for units of shares of a new company. Okay, all right. And then what?
So maybe company 1 got to vote whether or not it allowed company 2 in.
It's like an
Yes, there's an incentive for
Would
them
just feel
to
like an acquisition.
allow.
Well, maybe you could say that the index is composed of a percentage of the shares of each company. So like, you can dilute like your shareholders as much as you want, but you have to have a percentage, like at all times, 10% of your company has to be in the index if you're accepted.
That's an interesting idea. Okay, so it's like, so basically, how would that actually work?
So if you
though?
issue new shares, like you're gonna do like dilutive fundraising, or you're gonna do like new equity grants, you have to go and issue a bunch of shares, but then you also have to sell it on the public markets.
Right.
So it's gonna like affect
Okay,
your share
so
price.
let's stick with like kind of small numbers to make it easier to think about. So let's say that each company at the beginning only has 100 shares, and so then the R token is defined as basically like each R token is 1% of the outstanding shares of each company, which in that case means 1 share of each company. But then if a company switched from 100 shares to 1,000 shares, now the index would be defined as 1 share of the first company and 10 shares of the next company, because it's maintaining the equivalent like percentage of the total value.
But, you know, let's say the first company to come in was Amazon. All right, and now the second company that wants to come in is Mike. Okay?
That's
I-
not common.
Henry Inc. And does that mean that if I'm just willing to give up 1% of Henry Inc., I get
1% of Amazon.
1% of Amazon?
I mean, obviously that would not work.
I think you would have to auction off your shares to investors who would then purchase it.
Right, it somehow needs to just account for the market value. Right?
Yeah.
So.
The problem is our market value is defined by, I think in the stock experiment, by my percentage of the market index of this article.
Well, okay, let's say that, let's say a new company comes into existence, and before it is added to this index, there ends up being a free market for its shares, right? Then you can see the market value of those shares in terms of the existing index currency, right? So that information could then be used to decide, yeah, it's like, okay, basically, if you're gonna rebalance the portfolio of the index asset, yeah, that could just happen at market rates. Right?
So basically,
Early company valuations are so.
That's true. I mean, I guess a company would have to have reached the point of being publicly traded before it would be included in this index. So we're assuming that there would be a market value of the public market value of the shares. So yeah, startups not included, you know, same deal with startups, private markets, VC, et cetera. Public companies then can, you know, the governors can choose to include them in the scheme.
So presumably, if you can buy eggs with the index, that means that you also have to pay taxes in the index. Doesn't that give the government like a huge voting power in like every single company on earth? Isn't that like a conflicting?
It's an interesting point. So you're saying like the government owns a bunch of this currency, and the government owns a bunch of equity in all the companies.
And that means it has voting power in all the
How
companies.
much cash does the government maintain? I feel like they're taking in a lot of cash and spending a lot of cash. They don't have that much cash, do they?
It's less than $1 trillion usually at any given time, if you're talking about the TGA.
How much, do you know how much that is as a fraction of like all of the money supply? Like what percentage of the money supply is held by the government?
So the TGA is probably about 800 billion right now, and you know that's just money supply is a hard thing to calculate. What is money?
we do know the government. is
Well, okay, but for this, yeah,
I
that's
think
true.
for
But
example.
for this purpose, money is like base money because we're talking.
Okay, it's about 3 trillion base money, about 3.5 trillion.
Oh wow, so the government does have like a quarter of the base money.
That's kind of crazy.
That is a lot.
But if you owed it to people, would you get
That's
to
the
vote?
deposit at the Fed, not the deposit at a bank.
Yeah, deposits are much higher.
Yes,
24 trillion.
Yeah, and you have even more outside of the US.
Okay,
thing.
good point. I'm gonna take notes on these things.
Nevin, is your thought experiment?
I think the
about-
government's gonna end
Let's say
up
we
having to
tokenize
buy-
everything, would we just have basically, the whole, basically frame of reference will be reset such that we wouldn't have booms and busts because everything moved up and down together? Kind of like we're on Earth, we're moving at 100,000 miles per hour, but we don't feel it.
A great
because
analogy.
We're all-
Yes,
we're all
yes.
moving together.
That is what I'm getting at.
But I would say though, but that's true on an absolute level, but I think what matters to most people is relative prices. So even though we're sitting on this giant spaceship called Earth moving at 100,000 miles an hour, we still care about going 60 miles an hour in a car or 100 miles an hour. That's our frame of reference. So even if we were to tokenize everything, you know, let's say that we have a production change such that we can produce a lot more glasses much cheaper, that relative price of that would change and that would affect our experience, and we could have these relative boom and bust cycles simply because of these idiosyncratic things within different industries.
Okay, that makes sense, but let me frame a slightly updated question here. So, in my thinking about what could ultimately back our tokens, it seems to me that if you look at the sort of actual projected cash flows of companies, or rather, if you just look at like GDP of the US or global GDP, it seems to be more stable than market values of equities, right? But that's a little weird. Like in a sense, it seems like the market value of all equities should be about as stable as GDP if equities, if basically GDP comes from the cash flows of the companies. And so I explain that variation as basically investors, they're being sort of like bull and bear markets, where it's not the case that public market equity values always actually track the underlying value because you have these sort of momentum up and down market cycles. And so that's kind of those momentum up and down market cycles make me initially think equities would be not stable enough to use to back a currency, because if you look at, like Taylor was talking about, the drawdown levels of, well, really most assets, but equities included, they seem too volatile. But then that's sort of what gets me to this next question of like, okay, but if the currency itself were the basket of equities, and all the equities were just traded against the basket, would that somehow reduce that market volatility because you would somehow remove the ability to have bull and bear markets and speculate on sort of the total index of all the stock market, or not? That's kind of the motivation to this
I
question.
think that makes sense. We wouldn't have volatility, but maybe we would have volatility
So you think it would actually reduce volatility of
in
stock markets?
markets? Yeah.
You
because-
denominate one thing in the very same thing.
Yeah.
Therefore, you're not gonna have volatility. So you're gonna have volatility against glasses.
Yeah,
And
exactly.
you just switch volatility to somewhere else because your denominator and your numerator are the same. Therefore, there's no volatility. But that doesn't come free. It's just gonna switch.
So CPI might have more
Oh,
volatility.
I see. So you're saying like the way that humans value stocks would still go up and down as much. You obviously wouldn't see it nominally with this market structure, but you would just see all that volatility
Pop up somewhere
in the
else.
prices of consumer goods, basically.
That feels like the opposite of our goal.
Well, yeah, but let's just think about it. Let's just think about it for a minute. Let's just think about it. So, like, how would that work though? Like, how would the glasses prices go up and down? What
Well,
would
because to
drive
Joseph's point, if there's an innovation and all of a sudden you can produce glasses much cheaper, right? The prices of glasses will drop.
But that's fine. That's volatility that we're okay with. Just changes in like cost of production and whatever. That's all fine.
Yeah.
The thing we don't want is volatility from, expansion or contraction of the money supply that doesn't match the growth of the economy. Right? So what's the mechanism by which the money supply in this weird world would not match the expansion or contraction of the economy?
We're taking away seniorage from the government, right? So in your example, there's no seniorage, right?
True.
Right, so the government, I don't think they're gonna like that very much.
Well, okay, but let's just suppose hypothetically, for some reason, they went along with it. Where would the volatility sneak in? Like, why wouldn't it just be okay? Here's a different way of asking the question. It's like the reason why we have this volatility in markets, in my simplistic understanding, is like people want free money. So if you can buy stocks and have them go up and then sell them for more, it's just why people want to buy Bitcoin for less and sell it for more. People want free money. And that desire for free money, brief historical anecdote, the very first publicly traded stock in Amsterdam in like the 1500s, the Dutch East India Company, I think, literally the first one that was publicly traded, there was an enormous bubble, an enormous speculative bubble, where the trading mechanism was you literally would have to go to like a particular bridge in Amsterdam to find other people who were willing to trade their share. And it wasn't even that you could trade like fixed denominations of shares. It was like I had like a share of like this many guilders worth and I had to sell you the entire block. And even with that extremely clunky mechanism, there ended up being an enormous run up and bubble in the price and an enormous collapse. And I think that like the fact that it occurred the very first time and it occurs in like almost every public market that ever exists, I think it's just driven by the fact that if people see something going up, they're like, oh, so I can buy it and make more money. And so then they do. And that's then this self-fulfilling prophecy. We get all the speculative cycles of crypto and Bitcoin and so on because of that. And so in some sense, I'm like, that's so powerful. There's no way to make that go away. But then when I think about this weird thing with like, well, what if all the assets are just traded against the index of them all? I'm like, okay, well, at least in nominal terms, that does seem to make it go away. And then the question I come to then is, would that somehow calm humans? Would they be like, okay, maybe we'll make our money a different way. We won't make our money speculating on the stock market because that's not a way that you can make free money. The market just isn't volatile. We just are calm about the value of equities. Yes, you can put your money in and it'll slowly grow over time as the companies get more valuable, but there's no sort of market booms and busts. And so we're just going to change our perspective and we're going to focus on our jobs. Or is that just completely impossible and somehow it will sneak in some other way? But if so, how will it sneak in? That's what I'm
I
asking.
think typically, the way that this is done is that, one is that you raise interest rates, make it, I can make money just by leaving my money at the bank, maybe I won't speculate, that's one thing. Doesn't work that well all the time. Other things they do are just to make it more difficult to get leverage. So what they could do is raise the margin requirements. That's been effective. And so other things they can do is to make it so it's more costly for banks to make loans for speculation. That's been done. These are all things that people have done over the years to try to make it more difficult to have this kind of speculation. Because ultimately it kind of doesn't end well when people ultimately get really upset about it. So they do all that, but we always find a way. So today it's call options and through things like crypto. So it seems like it's human nature. We can make it more difficult for people to do this, but people will find a way around it.
Yeah.
It's just changing the denomination, and there's a new base, and therefore I'm going to trade the seashells versus S&P, or potatoes versus S&P, and how I'm gonna make money. They're gonna buy all the potatoes in the neighborhood at one S&P price, and then when people like, I want my potatoes, yeah, sure, like here is 1.5 S&P, and
I think,
So this is basically all like just everything turns into like a pair trade versus S&P or like versus the index. Like
What's a pair trade?
it's basically like with two correlated assets, you long one and short the other, so that like regardless of if the price regardless of where the market moves, you're still in profit, and you're basically playing like the beta of the asset that you're like long.
Okay.
yeah. I think to answer your question more directly from like a first principles way, I think it's correct to think about volatility as a function of liquidity. So like the reason why there's a ton of liquidity for Bitcoin when it goes up a bunch is because people found out about it, like, I'm gonna provide liquidity at like $100,000 because I see it's this thing that's growing. So it does seem like in theory, this hypothetical, if everyone is converting S&P 5 million for eggs, like the amount of eggs that you need is like fairly constant, as well as other goods and services. So there would be just a lot more liquidity in the market for this hypothetical asset. So I guess the ways that volatility would sneak in would be if there's some sort of liquidity shock from some kind of exogenous event.
But doesn't volatility go up when liquidity is lower? Or are you saying it goes up when it's higher?
I say volatility goes up when there's less liquidity.
Yeah.
so that thought experiment has been done in practice. Just think of something like stock market in Argentina or Venezuela, right? So in peso terms, that thing's been going bananas, right? Yet in dollar terms, not so much.
Right.
Right. So it's all about because all it does is just to your point, right? So you're protecting your money by being in real assets as opposed to depreciating currency. Again, depreciating against what? Depreciates against goods and services, and therefore US dollar. as more stable, sort of a low inflation currency, or euro or yen, maybe less so, but or any other, or eggs, or any
Yeah.
other asset. But in terms of Argentinian peso, it's going parabolic, right?
Well, okay, that raises a point, and let me use that to transition us to a different question here. So, a point that raises is like, in the world where you have the equities getting more valuable, and they're all traded against an index of themselves, such that in nominal terms everything looks nice and flat. It's like, well, but then you have your currency getting more valuable over time. That raises the question of, do you want your currency to get more valuable over time?
Against what again?
Well, against eggs, and glasses and so on. So basically, it seems like naively, like my simple answer is like, you want it to be totally flat in like average purchasing power terms. Obviously, some, TVs get cheaper and like some things get more expensive than ever. But like in terms of average purchasing power, my assumption is that you want it flat because, I don't know, just like sort of like morally, like I want it to be like I do this amount of work and then I get exactly that amount back when I spend my money. It's like one way of thinking about it. Another way of thinking about it is like, I don't want there to be like too much of an incentive to not spend money. Like if your money is getting valuable too quickly, then you sort of maybe want to hoard it. So maybe you don't want like a deflationary situation in terms of the money itself. But then also, having it depreciate seems annoying. A lot of us in the room don't want inflation. So I assume flat, but the question is, does it need to be flat, or is it fine if everybody's money is growing in value at the rate of the economy growing in value? Maybe that's fine.
I think if we're talking idealism, that like, there's a lot of poverty, right? We don't want to encode the amount of poverty into the future. So I think, yes, we do want a system by which standard of living increases over time.
But you can have standard of
average-
living increase without the value of the currency increasing.
Well, but the currency's buying power needs to increase, I think, in order for.
So that like people's savings in general is getting more valuable?
Yeah, like have somebody get out of poverty in your scenario.
Your loans, how do you pay back your loans if the companies are the thing that multiply capital fastest, right? And your debt is now growing at that rate, right? And you can only grow capital slower than companies, right?
That's an interesting point. Yeah, so if
Why can you only grow capital slower than the companies?
Otherwise, it'd start a company and beat them all.
But I just mean in terms of like the idea that our money becomes more valuable over time. There either needs to be more of it to spread among more people, or it needs to become more valuable. Like,
Yeah.
one of those two things has to happen, or else we've sort of.
Okay, no, so that touches on an interesting point, which is like, in general, you want the value of like all money in circulation, I think, to roughly grow in value equivalent to the economy growing in value over time. You have like more economic transactions that you need to represent, so the currency needs to get more valuable. That could happen by adding more units of the currency and the purchasing power staying flat, or by having the same number of units of the currency and the units get more valuable. Where like, I don't know, that
The units getting more valuable means that it's harder for additional people.
Means getting more valuable is a deflationary environment.
Right.
And then it is a magic tool called leverage, right? So, if you have deflation, you have, depends on the amount of leverage in the economy, the deflationary environment, that's a bad thing. Because your debt is becoming more expensive.
But I
Yeah.
think in this system, you would only, as a company, you would only take on leverage if you think that your productivity is gonna grow faster than the other companies, because that's what this currency is measuring. You're measuring like the productivity in aggregate of the economy to this index of companies.
Not just that, but then you have temporal transformation, that's what that is, right? Because when you're buying a house, you don't have, I don't know, $1 billion right now, so you need a temporal transformation, a little time machine that we have, right? So you take out the mortgage, right? And that's, and therefore, you need to adjust to that, because you don't want to have a mortgage in a deflationary environment.
right.
I think there's a huge difference also between like what is the growth of the economy and what is the growth of equities, right? Like there's huge requirements, legal requirements to even be listed on an exchange in the first place. And we're kind of, if we're saying that our basket is made up of only listed exchanges, we're missing the whole like non-IPO. Like I can't just go and buy shares of some random restaurant, even though that's like a huge part of the GDP. So I mean, personally, I think for the thought experiment, it'd make more sense to have this index be composed of like the CPI or commodities or something that's more linked to like what is the actual economy, like what actually matters to average people, as opposed to like what is the value of like voting power and some equity.
Right.
Because like again, there's huge like that changes the liquidity calculation, because these are the only things that like accredited investors can even buy, right? Like that's, I just don't think that the way that we think about equities in the real world would work at all in this like hypothetical situation. I just don't think it would like align with what I think you're trying to get at with the
I
analogy.
mean, that's a really interesting point, but practically speaking, how do you include those, how do you tokenize and include those parts of the economy? Because you have all these disparate businesses that like, you can't really, there's no market value for them, they're not liquid, et cetera. So I hear what you're saying, I just don't know how to do that.
I think it would have to happen at the fund level. It's like every state in America, when you launch a private fund, like you have to register with your state regulator. So perhaps part of that regulation process could be like you have to come up with some sort of agreement where the state would be, or whatever entity is administering this currency would be able to like have a 10% pro rata like for your early stage venture fund or for your private equity fund buying multifamily real estate.
Okay, so you're basically saying, take all the private funds and somehow facilitate them being, you know, part of them being tokenized and included in this.
Yeah, because I think you have to have some sort of minimum threshold for inclusion as a company, and I think being investable by a venture fund or a private equity fund like could be a good minimum threshold.
What do you think about that?
Well, I guess what about like real estate syndication? Like I don't know. This is actually, I don't know if you remember 2 years ago with one of the previous presenters, I actually pitched the idea of like, you know, let's build an art token full of this backed by commodities. That's more. I don't know. I don't actually think like what I really want. What I thought you were getting at initially. What I really want is an art token that I can hold that is like backed by SPY, so that I don't have to hold cash. I can just hold SPY because I just want to invest in SPY. And then like when I actually need cash, I don't need to, you know, sell that and like deal with that. That's personally what I want like an art token for.
What's SPY?
So
But then you're saying that's what you, but you do want that, or, but it sounded like before you thought
He
that it.
personally wants that.
yeah, like I personally want
Price goes down.
Yeah.
I just want to hit the S&P 500, and
Yeah.
then like when I want to, I can convert it to like $50 in cash. when I
Yeah,
want to.
yeah.
But you're worried that it doesn't represent the full economy, was your previous point, right?
Yeah.
Yeah.
It's
I
not,
don't know
but
that would
it
work
doesn't,
analogy.
like in a supply chain view of it, things, wouldn't, you know, small restaurants, they are buying from large producers or in an aggregate way, wouldn't be able to capture a big chunk of the economy by just tapping into, maybe not only public companies, but other, you know, affiliated.
But at the end of the day, everyone has a very different consumption basket, so you could potentially personalize something that makes it, that you could have a bespoke, somewhat token that tracks what you consume. Maybe I really like bacon, so I could have a bunch of pork belly futures and issue against that. Maybe I live in New York, I'll add some New York City REITs there, and that would track my consumption basket, and everyone has a different consumption basket. I think maybe having this goal of having a token that can track everything would make sense. It doesn't really reflect anyone's experience.
I think there's also a difference between currency and something you save in, medium of exchange and a store of value. I don't know that you really can have both. Maybe what we're talking about is something like really good collateral versus something we actually trade between each other. And that thing is probably still going to be debt-based.
You say that one more time? I was checking our.
There's two key things that are sort of in opposition. Medium of exchange, what is that's good for something right now,
Yep.
and what holds value long term. Right? So right now, in terms of collateral, that's treasuries. That is the good faith in the federal government. Right? That's what collateral is. It used to be gold. The thing you trade around in the gold standard was paper, it was a claim on those things. And in this case, dollars are derivatives of essentially debt in the United States government. But these are different things. Okay? Something you save in and something you transact in. But if there's a basket of everything, that feels more like a savings thing, not an exchange thing.
Can I ask though, if what you're saying makes a lot of sense when you think about an analog world. But in a world where we have our little pocket computers, is that difference, do we have to keep that difference? Like we had when you talk about the gold standard, people did take shavings of gold around with them, and they did make gold coins, but eventually they got to pieces of paper because it was a better technology. For trading the gold, not because it was a different concept. Whereas you're calling it a different concept.
I think they're different.
To add to Joseph's point, actually, I was going to talk about this last night, but I could envision quite easily like an app that was just like, oh, look, it's my universal portfolio that has all my things I want in it, and then you have one, like, whatever, and that's kind of building on that idea that it's just what you want and what they want, and there's more of a subjective quality to the whole thing.
Personal CPI.
I hear all that, but I would say to both of these points, which are different points, I'm still, maybe this is irrational, but I'm committed to this idea of just having one thing because like of the incredible value of fungibility and everything being able to be priced in a currency. It's like the fewer of them you have, the better for just simplicity of trading. So it's like if you can get something that is a good enough store of value that people really want to store a large amount of their value in it. Maybe not all. People still make investments, wealthy, people and companies and whatever will still obviously not hold 100% currency. But like, I guess my sort of utopian idea here is like, what if money were stable enough or maybe gained in value a little bit such that we were actually comfortable having, a much larger fraction of our wealth just in money. So we didn't have to spend as much effort, managing portfolios and converting these back and forth, and so that people were more focused on earning money and providing value to the economy rather than speculation. Is like that's sort of the driving ideal there.
Well, I think you're kind of like, I guess from like everything like you're sort of implicitly assuming that's not useful, like the quote unquote speculation, like price discovery is useful. Like the reason like stocks don't follow GDP is because it's based on growth expectations, not realized growth, right? And so
Yeah.
there's a price discovery process that happens there. So, like you can't tokenize everything because
I do value that. No, I do value that. It just seems like I guess I just think that maybe you can get plenty of that without without the situation we have today, where like nobody wants their money in even US dollars, even sort of the biggest, most popular currency. You don't actually want to store your wealth that way because it's losing value. And so then there's like a lot of effort that has to go into managing your wealth. It seems like you could still have a world where there's open free markets and people are welcome to speculate on things, but you just reduced a lot of the effort that went into that because it was actually fine to just have your wealth in money that would, sort of like in the gold days, it's like pretty much retain its value.
So in the gold days, could people literally just save gold? That's a silly question, but.
No,
Yeah, that's how that's what the hordes of coins come from that people find to this day, right? So you put it in a big jar and you bury it somewhere in your estate, and that's a way to save money, right?
Yeah, I mean, you could just save money. You could save money that way for your family for 100 years, which you would never get in cash until the government. Okay, so
just to create something close to a limited supply of token. Okay, you have Bitcoin, you have gold, you have silver, and you create a basket with. I maybe don't want to hold an R token that is managed by people, because if you're holding an S&P R token, it means there will always be speculation. But can we not create something more close to
have something like a Bitcoin, a gold, a silver, something like a basket like that.
Yeah. I almost feel like now you're describing a thing that's maybe an index that we want to know what we're assigning its everything's price against, but it doesn't really matter if anybody holds it. Technology can solve that. Like, could we agree on a monetary standard without having a currency at that standard, and then people can just hold whatever store of value they choose to, according to what Joseph was saying, like, this is my profile of what I care about my spending power being preserved, but I'll agree to this monetary standard as the way of knowing what my basket is worth.
I think the thing that matters there as well is like the unit of account, right? Like, it's just the dollar. Even if the dollar is not functioning particularly well, we all have a relative sense of.
Well, I think we'd like the monetary standard to function well,
Yeah.
but we don't actually have to hold it.
No, I hear that. Yeah, you could have, in theory, you could have a unit of account that is not an actual thing that anybody holds and spends. Like, I don't know the details of this, but I think in a way, the SDR is used by the international banking system like this, where it's like not a whole lot of people are like holding that basket exactly, but it's used to denominate certain contracts, right?
So it's with the IMF, people put money with the IMF, you get SDRs exchange it. It was kind of an experiment. I don't really think it's popular these days.
Yeah, but it's that same concept of like unit of account that you don't necessarily hold directly. And yeah, I mean, in theory that seems possible. I don't know that it ever would actually work in practice, because I feel like people want the pricing to be denominated in at least the thing that they hold some of. Like you want some certainty, but I guess you could just choose to hold some of it. I mean, that kind of gets us back in the situation that we have with cash. But okay, time-wise, I mean, this is great. I could just do this all day, but we are running a bit behind, and so we need to take a quick break and then move to the next conversation. At least one of them is going to be starting the conversation about RSR emissions. So I'm excited to dive into that. Before we break, though, is there anyone who has been quiet this whole time but has one idea or question that they want to throw out to the room? That can be the last thing we talk about before we walk away.
I think it's value. Oh, sorry.
I have no qualifications to be in this room, but I do, as an observer, enjoy the conversation. And one thought I had when you guys were discussing the last topic was that the way a user, say a more layman user like you, interacts is through a front end. And so what's going on in the background with collateral, what's making up these currencies, is less important than how we interact with it. And if you have risk and return on one end, and then on the other end you have stability, you're going to move your slider where you want it, where you're comfortable with.
Mm-hmm. Mm-hmm. Yeah. Yeah. So if you can give people a way to make the choice on that spectrum without having to get into all the technical details, so that could be a very valuable thing.
Everyone wants better, upfront.
Yeah, that's a forefront.
Yeah, I agree. And you had one thing you wanted to say.
Oh yeah, I was going to say, I think there's value if you can make it accessible for people. There is value in index linked money. So whatever the indexing is, if it's the S&P or something like that, but if there's a way that, you know, people spend a lot of money or a lot of time trying to find products or the securities that are linked to like the FTSE or the S&P and stuff like that. But with our tokens and baskets, if you can create something that's index linked that you can use for savings, you don't have to think about, and it's easily, you know, if it's easily traded, then there is a lot of value in that, I think.
Yep. Yep. Yeah, I hear that. Okay, all right. Thanks everyone for this engaging discussion. Let's take a 15-minute break and come back here around 11:45. In that room is where we're going to be having the RSR emissions discussion. And check what the other one is. Actually, yeah, that's the only thing listed this next slide.